As US crude oil stocks rise to records and there appears no let-up in supply from oil-producing nations around the world, is the worst yet to come for a price of a barrel of oil? Malcolm Graham-Wood joins us now from HydroCarbon Capital. What do you reckon? Because clearly we've seen this big knock, although, it has to be said, in the last week or so, there's been a bit of a recovery. Yeah,
we've definitely seen a recovery. I suppose it's about 20% off the low, that's been good, and there's been a lot of traders in there. Chartists feel very strongly that we have passed the low. I'm not convinced. I still think that we're going to try the lows again. We'll be back to probably $45 for Brent, and I think that the fundamentals are just still wrong. There's too much crude around. Every week we see the US stock levels going up, and I tend to believe that we have a U shape here, not a V shape. So I think what's happening is that we've got one more go, probably maybe two at the low, and then we'll stick along there for a while. There's a sort of crucial time halfway through this year. At the end of June, a lot of hedges fall off. So people all of a sudden, at the moment they're being protected by the hedges that they put in place. They often last up to 18 months ahead, and quite a lot of those will fall off because they won't have hedged anymore after June of this year.
Is that because that's when the next OPEC meeting is? I think it's 5th of June.
No. I mean, OPEC have two meetings a year under their constitution. I don't see them changing things. I mean, the exciting OPEC meeting will probably be in December. I think that by then, I mean, you do see a natural pickup in demand as the year goes on. I mean, OPEC are predicting 1.7 million barrels a day more demand in the second half than the first half. That will just take stock off the market, to be frank, at the moment. But by the end of December, they might be looking in a stronger position. So either at that meeting or sometime at the beginning of 2016, we'll start to see things balancing out quite nicely. The reason I've been bearish so far, ever since I came in here a long time ago, is that those sums don't add up at the moment. There's still far too much supply. The market is in contango, which means the price is further out are higher, so that it makes it efficient to store. But what that does is that although it's profitable and efficient to store, it means there's still plenty of crude oil on the high seas, which will come into the market. So I think at the end of this year, and at some stage, with a combination of supply, which is going to be falling because after these hedges fall off, people will stop, producing inefficient wells, and a pickup in demand, which is inevitable at $45–50, you'll see that sort of balancing out. And then when it does balance out, that'll be the time for OPEC to pull crude off the market and get the price going again.
So when you say you see a recovery towards the end of the year, do you mean a recovery from the new lows that you see expected, $45, $40, whatever it is, and then a recovery on from there back to where we are, or a recovery past where we are at the moment?
Oh, I think it'll be much higher than where we are at the moment. I don't necessarily see us going back to $100 anytime soon. But what I do see is us getting into a position whereby with equilibrium between supply and demand, and the market not quite so wash with crude oil, and probably using up some of those stocks which are being kept in tankers and so on at the moment, will start to pick up quite nicely. And don't forget, the longer it goes on, the bloke from ENI wasn't so far wrong when he said $200 oil, because if you see 70 billion of capex cuts, which is what we've seen in the last few weeks from the majors, it's going to restrict supply. And we've all been in this. I've been doing this sector for 35 years, slightly more, and I've seen, it's like any commodity, the cycles, they overdo it on the downside. I was up in Aberdeen last week, and people were worried about the fact that, the place is being, everyone's being sacked and everything else. Well, there are redundancies being made. A lot of the service companies are getting rid of people and so on. But it was only a year ago I was up there, and people like Wood Group were saying, I can't get enough geologists, I can't hire people. It's like investment banking. They sack Americans in investment banking. They sack everyone when it's going badly, and then hire them all 2 years later, twice the price.
Well, we've seen more evidence of that. Total is to sell $5 billion worth of refining assets, 2,000 jobs going. We spoke last time about BP sacking people. Tullow results. I'm not going to talk about results themselves, but just the other day when Tullow came through, yes, it slashed its dividend, yes, it poorly performed. But one statement that jumped out at me was, we're in a good position when the market does return. I mean, this is the point, isn't it? Can companies last until the market returns?
Yeah, I mean, I think the point is that this is where, I said in the blog the other day that this will sort the men from the boys, because what you need to do is to be able to afford to do what Tullow have done and have huge write-offs pare back their capital expenditure, inevitable passing of the dividend. I'm surprised that anyone was surprised about that, because it shouldn't happen. But actually, as per the bucket list which we talked about, you need to be looking at stocks which are going to be able to go through this and still be in existence in the end of this year. And Tullow have got 100,000 barrels a day coming from the Jubilee field, which being produced out of that, which will give them good cash flow as long as they can afford to write off the rest of it. They need to watch out for debt covenants and things like that.
So what are the
companies? I've got a little list.
Yeah, what companies are on this list then? I mean, the list of companies that have been bombed out completely. They've got good assets, they've got no debt, they're looking for production.
Yeah, I mean, what I'm looking for here is, I'm looking for stocks which have got good quality management, proactive, with assets that they can control themselves, i.e., take a bit of time to delay if need be, but in their own gift. I need them to be well financed so that they don't need to come to the market for money. The market is effectively closed at the moment. I don't want to have big shareholders who are knocking on the door. If you've got a big shareholder, they have to be supportive, and so you have a situation there. And then I want companies which have been probably well hedged. The ones that I'm looking at in particular in this respect, the bigger ones in the UK, things like Premier Oil, Faro, Ithaca. Premier, a much maligned company. People think it's just the North Sea and so on, but not the case. They've got... Yeah,
this is the Premier Oil share price chart. In fact, if you told me that was Brent, I'd say, well, yeah, it is.
Yeah, and the point is that when you look at these stocks, the ones that are going to come out of it are bottoming out quite nicely, and they might have another bad turn. But Premier, for example, have got gas contracts in the Far East, some of which go out to 2029, and they're getting maybe $15 an MCF for it. So that's not going to be affected by these things. And Ithaca, they've got a company. This is a company which is hedged a long way out, probably the best hedger in the marketplace, and in looking, very strong. And they've got Stella, which is a field in the North Sea, which will come on stream in the second half of this year. And the stock will look the same. There we go. It's they've all had a big fall. They've all come down. The Warren Buffett thing about the tide going out, but you want to be in the ones which are in control of their own destiny, with cash and good quality assets.
On your list, I notice you've also got Casa Oil and Gas. It's a fracking company, isn't it?
No, I mean, Casa have got this thing called Bone Spring onshore the US of A.
Right.
Now, a lot of people are worried about onshore US stuff because, this is where the sort of discussion about whether OPEC have done this in order to try and knock some of the US onshore production, particularly the shale and frack stuff, off the market because it's expensive to produce. But it's not always the case, and Casa have got really good quality acreage there, and they, again, totally discretionary. They own a lot of what they and operate a lot of what they have, so they can produce it if they want to, and they don't if they don't have to, and they're not tied in much by anything other than by production. So it's a good quality play. It'll come out of the other end okay. I'd want to put money into that in order to develop it whilst the assets that it's operating in are quite cheap.
How about some of the stocks in Kurdistan? We've spoken about this before as to how rich Kurdistan is in oil and how the prospects are. But this seemed to have been bombed out like any other sector.
Yeah, I mean, all bombed out as well. I mean, the ones I look at are Ganel and Gulf Keystone. And I mean, the problem with all the Kurdistan stocks at the moment is that they're not getting paid. And, you would worry about that if you thought that it was going to happen forever and ever, because, if you thought that there'd been problems between Erbil and Baghdad and that Baghdad weren't going to pay and everything else. Those problems are sorted now. Erbil and Baghdad are mates again. There are 3 ministers from Kurdistan in the Iraqi government now, and one of them is the finance minister. So, I'm taking it on trust, as is Tony Hayward at Ganel, and the guys at Gulf Keystone, that they will get paid. Now, the trouble is that there are probably 1 or 2 people in the queue in front of them to get paid. But I think that that they will get paid, and when they get paid, they'll suddenly get decent cash flow coming in. Some people are less patient than others, but I still think that I've got big valuations on these companies when it all comes right. You have to be patient and everything else.
Yeah, Gulf Keystone has almost been at these levels actually in the last 6 months, hasn't it? It's another dip down. It does have other issues, doesn't it, which seem all mostly to be overcome, aren't they?
Well, I think almost all the problems that historically we associate with Gulf Keystone are behind it. I mean, for once, they're actually delivering what they promised. They've got 40,000 barrels a day. They've got potential upside from that level, and they've got one or two things that in the past they've had some governance issues and so on, but they have a new chief executive, they've got a new finance director, CFO, and they've got some good quality non-execs. So I think those problems are behind them. I think that they're looking in much better shape. The market has given them no credit, but that's because the market worry.
What about Sound Oil?
I mean, Sound is in a very strong position. Sound is probably one of the best in the whole list, because Sound is onshore Italy gas. So onshore, I mean, historically the problems with Italy have tended to be, where we have, it takes a long time to get anything done, permitting and environmental stuff and so on. That's getting a lot better. The other thing is that because they're onshore, it's extremely good because it's quick, comes to market very quickly, and it's gas rather than oil. So it's not affected really hardly at all by the oil price at the moment. They're still getting a very good price for their gas, and they've got two developments which are actually producing gas at the moment, and that covers all their costs. So the company runs for nothing. They've got a big gas development which they're about to drill, which will bring in a lot of money over the next 2 or 3 years, and then on top of that they've got one or two really big potential upsides. Now this stock is 11p or whatever, and this is one of the stocks that's done very well. But in fact, I reckon that the value of the business, if Nervesa comes on, goes to between 20 and 30p a share, and then if Badile, which is their sort of big potential prospect, were to come in at the end of this year or beginning next year, I've got 30p a share for that on its own. So well managed, soundly financed, got a good supportive shareholder in Continental, very strong position.
Let me just quickly end on Afrin, on Afrin if we can, because Afrin is a stock that's been bombed out. It's got its own problems. Is this deal with Seplat, which we've been hearing a lot about, a last chance saloon for
well, I think it is in a sense, because I think tomorrow night or Friday night is the final time, and I mean they've had an extension on this potential offer for some time. I mean, my spies in the marketplace tell me that Seplat have offered what might be considered to be a derisory offer for Afrin, but as far as Afrin shareholders are concerned, any offer will be acceptable. I mean, who would say that these shares would be less than 10p a share? This is
8.1 pence.
Yeah, and this is rank bad management of a company. Obviously, we've had all the problems with the directors having been dismissed and fingers in the till and all that sort of stuff. But even since then, the company hadn't worked out that their debt situation, and so they're not only having to try and see whether Seplat will come good with a deal, but they're also trying to get an extension on current debt repayment. So they're not in a good place. Nor do I think that if there's a bid, it's not going to be much higher than the current level. So it'll be a get out of jail bid rather than anything else.
Thanks indeed for dropping by. It's Malcolm Graham Wood there from HydroCarbon Capital.